Jimmy, thanks for being with us this morning. I want to get your thoughts on that and some of the messaging that we are getting out of the Fed right now, and the fact that maybe there is perhaps, at least in recent days, a little bit of disconnect between the commentary and what the market is pricing in, and how investors should navigate that divide.
Thanks for having me on the show. I think the Fed officials are also grappling with the issue. We still have one more inflation reading before the March meeting. And I think they realize they're behind the curve, but at the same time, they don't want to acknowledge that they've made a policy mistake. And a 50 basis point hike would send a signal that they're perhaps panicking a bit, acknowledging there's a policy mistake. So I think it's a close call. But I do think that with the market now pricing in a potential for 50 basis point hike, they do have a free pass to do so at the March meeting without seriously rattling the market.
So from an investor standpoint, when we talk about don't fight the Fed, how does that play out, and how are you putting money to work, I guess, based on your interpretation of that?
Yeah, so if you look at the last 3 years, we've had 3 consecutive years of double-digit gains for major indices. The S&P 500 returned 100% cumulatively in total return over the last 3 years. And yet the earnings only grew 28% cumulatively during those 3 years. So it came from mostly PE expansion, and that's a result of extremely accommodative Fed policies. And now that the Fed is reversing, this trend, I think potentially it's going to be a choppier environment. So I do think investors need to get more defensive, think more about risk management rather than swinging for the fence.
Jimmy, how does defense look in this context? Obviously, past Fed tightening cycles, when they've started, yes, there has been more choppiness typically, but usually the market does work its way through them. And meanwhile, we have right here a time where investors seem to be very hesitant to buy bonds, to own bonds as rates are going up. So if you're running a full portfolio, how would you turn it more defensive? And does that include perhaps tacking into bonds as yields go higher?
You raise a really good point. This is a very unusual environment because in the past, usually when equities come under some pressure, the treasuries tend to rally. And so you have a hedged portfolio. But this year may wind up something closer to 1994, with bond yields rising along with equities under pressure. So that makes it very difficult to play defense. I would say, if appropriate, and if investors can get exposure to well-managed long-short equity strategies, that would be a way to allow you to go on the offense when the markets are, going through a difficult period, by being net short. On the other hand, within equities, you want to, stick with, the shorter duration equities rather than longer duration equities, meaning a shift from growthier part of the market into more value, more cyclical stocks, which, will give you a fighting chance.
Shepard Smith here. Thanks for watching CNBC on YouTube.